Hey guys, what is going on? Welcome back to the portfolio. Welcome back to the channel. As I do with every video, I want to start off by saying thank you to all the subscribers, all the viewers on the channel, showing the channel so much support. Immensely appreciate that. For today's video, I thought I'd mix it up here a bit with the style of the video and talk a little bit about tax rates. There's been quite a few viewers on the channel wondering about taxes. It's tax time. So I thought I'd take a look at long-term and short-term capital gains, as well as qualified and unqualified dividends, to kind of take a look at how you can be more tax efficient, how you can save money at tax time by utilizing long-term capital gains and qualified dividends. So let's first take a look at the tax brackets within the United States. As you can see here, a number of different tax brackets. It's a progressive tax code. As you make more money, the marginal tax rate on that income increases. So for example, if you make from anywhere 0 to 10,000, you pay 10% of that income to the federal government in the form of tax. If you get above that, 10,000 to about 40,000, you pay 12% of that, 40 to 85, 22%, so on and so forth. If you get up to the highest income tax bracket there, 520 plus, you're paying 37% of that. Anything over 520, you pay in the form of tax. So those aren't the effective tax rates. Essentially, you just add those up. So for example, if you made $90,000, the first 10,000, you pay 10% tax. 10 to 40, you pay 12%. 40 to 85, you pay 22%. And anything over 85, you'd pay the 24%, and you would add up all those tax rates, the taxes over your income, and that would be essentially your effective tax rate. So progressive in nature, but there are ways in which you can save from paying on long-term capital gains as well as qualified dividends. And just to kind of take a look at historically what some of the higher marginal tax rates were, you can see here up to 90%. So there's a few tax brackets quite some time ago, but they did get up quite high. So if you did fall into one of the higher tax brackets, you'd be paying essentially 94+%. I think the highest was 94% back in the 1930s or so. So definitely, the more money you make, the more money you're going to pay in taxes. But let's take a look at what long-term versus short-term capital gains are. So first of all, the capital gain refers to profit that results from a sale of a capital asset, such as stock. It can be bond, real estate, where the sale price essentially exceeds the purchase price. So the gain is the difference between the higher selling price and the lower purchase price. So essentially, you buy stock at a lower price, sell it at a higher price. That difference you have to pay tax on. And if you take a look at long-term capital gains, this is where you can get the advantage of paying a lower tax rate than your ordinary tax bracket income. A long-term capital gain is tax on profits from a sale of an asset held for more than 1 year. So if you buy a stock, hold it for a year or more, and then sell it off, you pay significantly less at tax time. If we take a look at that here, you can see again those tax brackets. I did round off here a bit. The income tax bracket level, that's your ordinary income tax, and then long-term capital gains, as well as qualified dividends, which we'll talk about as well. So let's say you fall into one of those mid-range tax brackets. Let's say you pay, or let's say you made income of 95%. Initially, you would pay 28% on your income, and then if you had capital gains, you'd also pay 28% up to $188,000. But if it's a long-term capital gain, again, if you buy a stock, hold it for more than 1 year, and then sell it off, you actually reduce that to 15%. So quite a significant savings there. Let's say you got up to the highest tax bracket there. Again, these are a little bit different just because of different years I used for both of these tables here from that prior tax bracket table. If you make more than $408,000, your income tax bracket would be 40%. But again, if you bought a stock, held it for a year, and then sold off, you'd only pay 20%. So you essentially save yourself 20% on taxes. So let's say you buy a stock, hold it for 6 months, sell it off. You have to pay 40% on any gains that you make. But if you hold it for over a year, you essentially saved half of your taxes. So you pay 20% instead of 40%. And then if you fall into one of those lower income brackets, you essentially pay 0% tax. So quite significant savings. So if you're buying and selling stocks quite regularly, you may want to hold it a little bit longer term, especially if you have a big gain, because you'll have a significant tax savings if you qualify for those long-term capital gains. And then also qualified dividends. Essentially, there are certain dividends known as qualified dividends that are subject to the same tax rate as long-term capital gains, which are lower than the rates for ordinary income as we described. And essentially, you have to hold the stock 60 days before or after the ex-dividend date. So the ex-dividend date is when the ownership of the dividend changes hands. So if you buy the stock before the ex-dividend date and then you hold on the ex-dividend date, you can sell off on the ex-dividend date or thereafter and still receive the dividend, you simply would have to buy the stock 60 days before that date, or hold the stock if you bought it on or right around the ex-dividend date after that. So a couple different ways in which you can do this: either buy the stock early, or after you buy the stock, you have to hold it for at least 60 days after the ex-dividend date. But either way, again, you can lower the tax rates, again, from 40% to 20% in the higher income tax brackets. In the lower income tax brackets, 10 or 15% goes down to 0. So significant savings there by doing long-term capital gains, again, holding a stock longer than 1 year before selling it off, or qualified dividend. If you do get into a dividend stock, hold it at least 60 days before or after the ex-dividend date. If you do that, you pay significantly less taxes at tax time. And here's just another little diagram explaining exactly what the ex-dividend date is. Again, a dividend is announced on the ex-dividend date. That's when the ownership of the dividend switches hands. So on the ex-dividend date, the prior holder of that stock receives the dividend, and then thereafter it's ex-dividend. So the buyer on the ex-dividend date or thereafter does not receive the dividend until the next ex-dividend date. So essentially, you have to hold it the day prior to the ex-dividend date in order to qualify for a dividend. So just wanted to quickly go through some of those terms, what the difference between long-term and short-term capital gains, as well as qualified and unqualified dividends. If we take a look at my portfolio here, let's go ahead and go down to Boeing as an example. So here is Boeing. If we take a look at some of the trades I've done, let's go down to some of the buy orders on the bottom, and you'll see that there are quite a few market buys here in April 2020, March 2020. If I hold that stock longer than March 25th, for example, this year, I'll pay a significantly less tax rate than I would if I sold it off today. So if I sell it off after March 25th, March 26th, March 30th, or April 1st, I essentially will decrease my tax rate by quite a bit. Again, going back to the graph here, from the ordinary income tax bracket tax rate down to the qualified dividend tax rate. So again, quite significant savings. Higher tax bracket, essentially half of it, and the lower tax bracket, no tax at all that you need to pay. So that's kind of what's driving some of my decisions on the portfolio. Boeing here, I did put a call order in, but essentially I don't want this to be sold off until after March. After March, it's okay. The taxes will be saved, but I don't really want to sell this off before March 25th, 26th. Otherwise, I'll be paying significant taxes. And you can see here, buying 200 shares at 184.46. So definitely don't want to sell that off before March. But after March, I'll be more than happy to sell that off, make that swing trade a positive swing trade, and pay significantly less taxes than if I were to do that trade now, less than 1 year of holding the stock. So I hope that makes sense for you guys. Again, if there's any questions about this, let me know in the comment threads down below, and I'll do a follow-up video if there's any issues with this video. And again, let me know if you guys like this style of video. Decided to mix things up here a bit with a little bit different type of video here, focusing on tax rates rather than the portfolio. But again, I don't want to make the video too long here, so I'll end it here. If you guys enjoy the content on the channel, if you guys enjoy the video series, feel free to like, share, and subscribe. Until next video, we'll see you then.